let's talk about the statement of cash flows. It is a financial statement that is not created from the accounting cycle, and it explains to the world how we got from our beginning cash balance to our ending cash balance. And it's going to break down the changes into three categories: operating activities, investing activities, and financing activities. And the problem is, when we debit and credit cash during the year, we don't have categories for operating, investing, or financing, so we have to kind of solve a puzzle. Before we even start on that puzzle, we can look at the balance sheet at the end of last year, which is the balance sheet at the beginning of this year, and we can see what the cash balance was at the beginning. And we know from our balance sheet at the end of the year what our cash balance is at the end. So we know what the change in cash is. We can fill out the bottom part of the statement of cash flows because we know cash at the beginning, we know cash at the end, and hence we know the change in cash. We just have trouble breaking it down by operating, investing, and financing activity, and that's when the puzzle kicks in. Okay, so what do we mean by operating activities? Operating activities are our income statement items, and there's two different ways to fill out this section of the statement of cash flows. The direct method, which says we got this much cash in from our customers, we paid this much cash out to our suppliers and employees, so we netted this much cash from operations. But the way that 95% of the companies do it is the indirect method. They start with net income and they work backwards, and that's what we'll use in this class. What do we mean by investing activities? Changes in investments and long-term asset items. So if we buy new equipment, if we buy a new building, if we buy land, that's cash out. If we sell an old building, if we sell old land, if we sell old equipment, that's cash in. And what do we mean by financing activities? Changes in long-term liabilities and stockholders' equity items. Borrowing money, repaying money, selling stock, buying back stock, or paying dividends. And the way we're going to solve this puzzle, since we don't have the accounting cycle to guide us through creating the statement of cash flows, is we're going to look at our balance sheet at the end of last year, which is the beginning of this year, and the end of this year, and we're going to look at changes in those items. We're also going to look at our income statement when it comes to creating the operating section of the statement of cash flow. For example, for the operating section, we're going to start with net income and work backwards. That's called the indirect method. Well, in here somewhere in selling general and administrative expenses is depreciation expense. That's a non-cash expense. We don't write a check for depreciation. We just debit depreciation expense, credit accumulated depreciation. So the first thing we're going to do is add back depreciation expense to our net income number as we convert to a cash basis income statement. And then what if accounts receivable at the end of the year are higher than they were at the beginning of the year? Well, that means our customers owe us cash. So we have less cash than you would think looking at our income statement. What if prepaid expenses are higher at the end of the year than they were at the beginning of the year? Well, then we paid cash out for expenses that haven't hit our income statement yet. So we have less cash than you would think looking at our net income. What about inventory? What about supplies? Well, if any of these current assets related to operations go up over the course of the year, that means we have less cash than you would think looking at our income statement. On the other side of the balance sheet, what if accounts payable has gone up? In other words, what if we don't pay all our bills? Well, if we don't pay all our bills, we have more cash. What if we've accrued for expenses? In other words, what if we haven't paid all our bills? We have more cash. What if there's unearned revenue that's increased? If unearned revenue is increased, that means people paid us cash for services that haven't hit the income statement yet. So if these guys over here go up, that means we have more cash than you would think looking at our income statement. So on our statement of cash flows, to figure out our cash flow from operating activities, we'll start with net income, add back depreciation because it's a non-cash expense, look at the changes in these current asset accounts over the course of the year, look at these changes in these current liability accounts related to operations over the course of the year, and then adjust for any gains or losses. So if we had a gain on the sale of property, plant, and equipment, it showed up in our income statement but that isn't operating activities. That is investing activities. And besides that, the cash that we got from a sale isn't always equal to the gain or the loss. That would only be the case if the property, plant, and equipment had a zero book value. So what we'll have to do is start with net income, add back depreciation expense, adjust for these changes on current assets, adjust for these changes in current liabilities, and adjust for any gain or loss on the sale of property, plant, and equipment, and we'll end up with our cash flow from operating activities. For investing activities, we'll look at changes in property, plant, and equipment or long-term investments over the course of the year, being mindful of the fact that just because property, plant, and equipment went up by $100,000 doesn't mean we necessarily spent $100,000 cash. It could be that we got rid of some equipment, so we credited property, plant, and equipment for some dollar amount over the course of the year. And for financing activities, we'll look at the change in long-term debt, change in capital stock, change in additional paid-in capital, and we'll check to see if we've written any checks for cash dividends over the course of the year. And as we say, since we can look at our balance sheet at the end of last year, we know what our cash was at the beginning of this year. We can look at our balance sheet for this year and see what our cash was at the end, so we know what the change in cash is. We know the answer to the puzzle, if you will. We just have to make sure that our calculated cash flow from operating activities, plus our cash flow from investing activities, plus our cash flow from financing activities equals that net change in cash.